Hello there. Welcome to another episode of Physician Estate Podcast. This is your host, Dr. Harsha Mule, owner and operator of Physician Estate platform. I am podcasting to you today from Miami, Florida. Physician Estate is a physician-owned, physician-operated platform directed towards doctors in USA. We provide free real estate resources and investment opportunities to physicians. We facilitate physicians to make wealth and keep wealth. You are currently listening to podcast number 11 of Physician Estate. In this podcast, I will be going over how can physicians use their retirement accounts to fund a real estate deal. Remember the famous saying, old is gold? Real estate investing is one of the oldest, tested methods of creating long-term wealth. Its ability to generate multiple revenue streams makes it a popular investment instrument for investors of all ages. In fact, financial experts even consider real estate as an excellent asset for retirement accounts. Yes, you heard that right. The IRS allows individuals to invest in real estate using their retirement funds. What's the relevance of this topic? Let's learn about how physicians can use their retirement accounts to fund a real estate deal. Since we are trying to keep this content relevant to physicians in USA, let's take a real-life retirement situation. According to US Department of Labor, the median pay for surgeons and physicians in America stands at $208,000 per year, significantly higher than the average US worker. An average American is likely to change as many as 12 jobs in their lifetime, which means that they have multiple retirement accounts with several custodians. The general trend is to invest these retirement funds into stocks, bonds, mutual funds, and other traditional asset classes. Our team decided to explore alternate investment assets that you can add to your retirement portfolio. And real estate was number one wealth generation instrument we discovered. Let's find out how you can invest in real estate through your retirement account. There are 6 steps for a physician to use a retirement account to fund a real estate deal. Step 1. Open a self-directed retirement account. The first step is to consolidate one or more of your multiple traditional retirement accounts into a self-directed retirement account. Your traditional retirement account, like 401k, 403b, 457b, etc., are held by a custodian. Contact that custodian and tell them your plan for rolling over a traditional account into a self-directed account. Not all custodians offer self-directed retirement accounts. In that case, do some research, consult your accountant to get referrals for a custodian that offers self-directed retirement accounts. After that, roll over your funds into your new self-directed retirement account. There are many types of self-directed retirement accounts. Self-directed IRAs and solo 401k retirement plans are quite popular among investors planning to invest in alternate assets such as real estate, precious metals, or other digital assets. How to decide if you have to go with a self-directed IRA or a solo 401k plan? You can choose between a self-directed IRA and a solo 401k plan based on the comparison mentioned in the table listed out on the website blog post. You can find the blog post at www.PhysicianEstate.com. The key topics of this table include: in a self-directed IRA, you need a custodian consent, there is transaction fee, there is no participant loan, but there is a tax called Unrelated Business Income Tax, UBIT tax. Annual contributions are $6,000 plus $1,000, close to $7,000. And then there is built-in Roth contributions. In a solo 401k, it allows for alternate investments just like self-directed IRA. You do not need a custodian consent. There is no transaction fee. You can take a participant loan. Most importantly, there is no UBIT tax on it. There is no unrelated business income tax. Annual contributions can go up to $60,000 per year. To open a solo 401k account, you must have some self-employment activity going on at the time of opening the account. What that means is you need to be the owner of a small business and be receiving a W-2 from your business to be able to contribute to solo 401k. This could be independent contractors, locum physicians, business owners, or solo proprietors working for their company. All these people are eligible for this solo 401k. Note that income you make on a self-directed IRA is subject to UBIT, unrelated business income tax rates, and these are similar to corporate tax. Moving on to step 2, fund your self-directed retirement account through qualified rollovers. In this step, you need to fund your self-directed retirement account through annual contributions or qualified rollovers. The IRS allows plan participants to roll over their existing retirement funds into a self-directed IRA or solo 401k plan. Step 3. Find an ideal property for investment. Once your self-directed retirement account has funds to invest, find an ideal property to add to your portfolio. It could be a single-family rental, small multifamily apartment, or a commercial building. Make sure that the property has a positive cash flow. Step 4. Use your retirement money to fund the purchase. After identifying the ideal property, purchase it with your retirement funds. Make sure that your retirement plan is the title holder of the property. You'll sign on its behalf as the trustee of the plan. If you require additional funds for the purchase, choose a non-recourse loan. If a borrower is unable to repay the loan, the lender will use the collateral to collect the money, but they cannot go after the borrower's personal assets. That's a non-recourse loan. Step 5. Pay for maintenance or repair from the retirement account only. It is critical to understand that any maintenance or repair costs associated with this property should be paid through your retirement plan account only. The IRS forbids the use of personal funds for the maintenance of this property. Please make sure to avoid any prohibited transactions throughout your holding period of the property. Step number 6. Receive benefits through qualified distributions. Receive benefits through qualified distributions. Once you reach the eligible retirement age, you can sell the property or receive it as a distribution from your retirement plan. Do understand that you will have to pay the applicable taxes at the time of withdrawal. In the case of Roth Solo 401k plan, your distributions would be exempted from any taxes at the time of withdrawal. If you are not using a Roth plan, that is, if you are using a tax-deferred self-directed plan, either self-directed IRA or a solo 401k, you will start to grow your money in a tax-deferred way, which is preferred by some investors. In conclusion, in addition to providing consistent rental income, tax deductions, and capital appreciation, real estate investments offer diversity against market movements. If you are wary of the market volatility and need robust income-generating assets, or if you want to sell some of your stock portfolio at an all-time high and reinvest that capital, real estate is an ideal choice to consider. That should bring us to the conclusion of this chapter. Thank you for listening to another episode of Physician Estate Podcast. In the next episode, you will be learning about 1031 exchange in real estate for physicians. To receive more information on real estate resources for physicians and to get updates on real estate investment opportunities with Physician Estate, please subscribe to our newsletter at PhysicianEstate.com. Do not forget to take advantage of our 2 new eBooks, ABCs of Real Estate Syndications for Physicians and How to Avoid Medical Malpractice Lawsuits. Signing off for now, this is your host Dr. Harsha Muley. Until next time, keep wealth and make wealth.
Disclaimer: I am not a legal advisor or investment advisor. The content in this podcast is not investment advice. This is my personal blog, and all the content found here is for informational, entertainment, or educational purposes only. It should not be construed as personal investment advice.